So as an investor, it's important to understand that you have to choose what hill you want to die on. So it's important to recall that the reason why we actually chose to invest in the first place is because we didn't want to save the amount of capital out of our incomes to fund future retirement, future lifestyle goals, and become financially independent. That doesn't mean that you can't. If you need $3 million to become financially independent and you don't want to invest, you simply would just have to actually save $3 million. Now, because most people cannot do this, nor do they want to, they're saying, how can I get a return on my money or my assets so that I can save less and have more money at the end of, in my lifestyle and for my retirement? So that leads the question is, what hill do you want to die on? Do you actually want to choose to be really, really conservative? Do you want to invest in risk-free securities, guaranteed securities, bonds, etc., to avoid risk altogether, knowing you have to invest substantially more? Or do you want to go on the full opposite side and invest strictly into riskier assets such as stocks and companies and private investments, etc., knowing that you'll get a much higher return long term, but you're going to be faced with a lot of risk and volatility? And that doesn't mean that you have to pick one or the other, but you have to be conscious about what your decision is. And so usually what the sweet spot is for most clients is, how can I obtain close to market returns, if not better, and how can I have the same element of risk on a realistic basis as my guaranteed securities? And that's why owning a perfect, balanced, non-correlated portfolio, much like the risk parity asset allocation that we tout to our clients, that has proven that during extreme parts of market volatility, that you actually are going to protect capital the best. And again, it's not going to be perfect. There's going to be moments in time where it's going to falter because asset classes are reducing altogether. But in a nutshell, it really does combine the best of both worlds, and it's important to focus on what you're trying to accomplish, because you can go on either end of the spectrum. But most clients, even though you can make the most money investing in the market solely on its own, they really can't handle the 30 to 40% pullback in market prices that occur since the beginning of markets almost every 10 years. So that doesn't mean that that's not the best way to invest. It just means that we've seen the white in people's eyes. They cannot stay true to their investment thesis going through those periods. So the next best thing is somewhere in the middle where they're not exposed to 100% of the risk, but they're still obtaining as much upside as possible when compared to the market. So hopefully this video has been helpful. We're going to reach out to you again tomorrow with another thing to focus on during volatile markets. If you like the video, please like, share, give us your feedback. These videos are for you, and we want to make sure that we keep our clients and our community as educated as we can during these points of contention in the markets. So we'll take care.